are times where someone has actually taken out, a senior has taken out a reverse mortgage, and the family didn't know about it.
Got-
And the family doesn't know what to do about it. And let alone, and you know how life is, right? Life works this way. If something bad happens, it gets repeated 11 times.
Yep, yep.
And anything good happens, it doesn't get repeated hardly ever, maybe three times they say.
Right.
Right? That's just how we are, as people, right? So everyone wants to know about this because usually, and because the question is something, it's a seminar we actually do at NARAB, National Association of Real Estate Brokers, which is the oldest trade organization for African Americans in real estate. Shout out to them. Uh, we came up with a seminar called "What to Do with Big Mama's House." It's one of, actually, it's not we came up with it. It's one of the ones that we put on Wealth Building Day. Okay, it's called "What to Do with Big Mama's House," and reverse mortgage comes up in that conversation because everyone knows that that house is worth something, and the question is, all right, when the house is sold, how much are we going to get from that? And then if there's a reverse mortgage on there that we know about, well, how does that work? How much time do we have? Things like that.
Gotcha,
Yep.
gotcha, gotcha. So,
So I think it's a great topic.
gotcha. So, let's start off by introducing yourself and telling us a little bit about what you do in general.
Sure, absolutely. So again, Brian Washington, my NMLS number is 658931. That's my, for my compliance folks out there. But I am a loan officer, senior loan officer with Loan Depot. Loan Depot is a nationally ranked company, usually in the top 1% in all the major categories. When it comes to first-time home buyer programs, we've been number one. Renovation products, number one. So we're in the top 1% usually all the time for something, VA loans. And now even in reverse mortgages, we're definitely making some noise there. So myself, I've been in the mortgage business now since 2002. And prior to that, I was doing loans and investments. So I really take an advisory approach. Always try to make sure that, when I talk to clients, whether we're doing, their first home, be it an investment property, be it their dream home, being it a renovation loan, and now reverse, I always make sure I take that advisory approach. Try to use the latest software and technology to make sure the clients understand, okay, hey, this is what's going to happen when we go to closing. This is what your monthly payment is going to look like, et cetera, so on in the process. Again, I take an advisory approach. Been in this business now almost just under 25 years. Sounds funny saying it that way, but yeah, like to help get it done.
Yes, sir. Yes, sir. Yes, sir. So, I'm I walk into your office, man, and I don't know what I want. Do I want a traditional mortgage or do I want a reverse mortgage? Because I just hear a lot of different things out there. What determines what loan I should go after?
It's a great question. Honestly, it just depends on the person. Many times, when I'm talking to, a client, I'll refer back to this scenario more than once because I think this really encapsulates what and how a reverse mortgage can work for a client. Okay. So one of my clients that I've helped in the past buy a home. She's now in a situation where she has, retired. And now, of course, your income, in most cases, it doesn't go up, right? When you retire, it goes down. Okay. So she still got this mortgage payment. The good news is she's got equity in her home, which kind of goes into the name of the reverse mortgage, which is HECM. Okay. Home equity conversion mortgage. Home equity conversion mortgage. So you're converting the equity, okay, into something that's going to benefit the client. So again, going back to this client, she is like, hey, Brian, mortgage payment's a little too high. I'm happy with the house, but At the same time, I'm thinking about, downsizing at the same time. So what happened here is we structured two scenarios. One scenario, she could stay in the house and have no mortgage payment. The other scenario was sell the house. Okay. This is where it gets really interesting. Sell the house, buy a new home with the reverse mortgage or HECM. Okay. Have no other debt and have no mortgage payment. So all of a sudden, just from a broad stroke standpoint, we figured out at a high level she was going to have to figure out what to after she paid her other expenses. She's going to have to figure out what to do with $3,000 per month. Okay, I said, you're going to be calling me at some point and say, hey, what do I do with this? Now, I don't have the answer because I don't wear that financial advisor hat anymore. All right. I don't have my, licenses, that I had when I was in Atlanta. Now I'll be referring her to one of my financial advisors and say, okay, now that you've got your emergency money in the bank, you got 30 some $1,000. Now let's put the rest of that away.
Gotcha.
Okay. Yeah.
Got,
So. So that's
gotcha.
that's a nice way to look at it because I was introduced to Heckham's reverse mortgages years ago. Um, and it was, a client actually introduced it to me. Like I said, I lived in Atlanta, Georgia. I was doing loans and investments. That means I was in a bank branch. And one of my conversations at the bank branch, I could be talking to someone about a basic checking account. The next conversation, I could be talking to them about, their investments. Somebody left behind money for a trust or an inheritance. Okay, what to do with that money? Another person, could talk, talk to them about a commercial transaction. And then this one client came in and he said, here's where I am. I'm doing my profile. And he says, I don't have a mortgage payment. I said, oh, okay. But you said you had a mortgage. I do, but I don't have a mortgage payment. All right, you want to explain that? How does that work? He
Right.
said, it's called a reverse mortgage. So that was my first introduction to it. And, hey, he didn't look like us. It was a new thing. And this comes from HUD. This product comes from, one of our federal government agencies. So does that mean it's safe? Does that mean, nothing bad can happen? No, you have to still manage it properly, just like anything else. Okay. So it's a great product for, to your point, which is you're leaning toward like who is it for? Who is it for? Is it for everybody or is it for some people? I would say it's for some people. Not everyone's going to be able to qualify because the qualification really boils down to how much equity you have in your home and your age. Okay, so those are the two starting and major factors into all right. Is the HECM, is the reverse mortgage product, is it a good fit for you? Okay, is it a good idea? All right.
Got,
So now so again, my client, we're trying to look at it to see can you stay there and have no mortgage payment, or say again, let's say you want to stay in the house. Here's the other thing that you can do. I didn't talk about. Let's say you can't make that $3,000 payment anymore, okay, because your income dropped. But guess what you can do? What can you pay is the question. Well, I can pay 1,500. All right. Well, if you have a reverse mortgage, you have that option. You can pay the 1,500. Okay, because what's going to happen over time, because it's reverse mortgage, and let's talk about reverse by talking about forward. With the forward mortgage, you and I both know what happens. You get a mortgage, you start making payments, right? And the balance goes down over time, right?
mhm,
Well, with a HECM or reverse mortgage, you get a mortgage, reverse mortgage, you make no payments, and the balance goes up.
mhm,
Okay. Now, think of it this way. If you want to keep the house or if you want to have some equity left over for your relatives, for your heirs, or for your estate, okay, you don't have to make the $3,000 payment. You can make a payment. So then the balance doesn't grow as fast as it would otherwise. Okay, if you made no payment. So you can make no payment, you can make a payment, okay, or you can make a regular payment, whatever you want. It's up to you.
gotcha. Gotcha. So now I walk in here, man, and I'm 63 years old. I'm a buff guy. I go to the gym, man. and and is 63 a age requirement? What does my property have to look like between my age and the property? What does that look like? What does it have to look like?
First of all, I'm glad you go to the gym. That's good. But the age is 62 is your bare minimum age now. Okay. For the HECM, you have to be at least 62 years of age. And for all intents and purposes, when it comes to this conversation, because in our business, you know how it is, for us myself, we always have to be conscientious of who we talk to and what we're saying, right? And age discrimination is a real thing in our business, right? But when it comes to a HECM, there's a backdoor, if you will, this level of discrimination in the fact that the younger you are, the more equity you need to have in your house. Okay. Or if you're looking to buy a house, if you're 63 years old, you need to have, and you're going to be buying a house and you want to use a HECM, you're probably going to need to be ready to put down, quite a big number. Okay. And there is no set number, and you probably hear me hesitating to say a number because guess what? It just depends on what interest rates are at the time. Okay. Because that's something a lot of people don't know and understand. Interest rates matter in all mortgages. So in this case, we're in a higher interest rate market than we were before, right? So now you have to have, let's say, 80% equity. But if interest rates drop, maybe you only have to have 70% equity, or because of your age. You follow me? So there are actuarial scientists, people who have thicker glasses than mine, okay, that are behind closed doors doing numbers and crunching numbers and saying, okay, this person, the average person who comes in and does a HECM loan based on their age, et cetera, we think they're going to live this long. So therefore, this is how much equity they need to have. And based on current interest rates and the equity and values of homes are average 4% per year. So they're doing all this type of mortgage nerdy stuff behind closed doors to figure out, okay, so I can come across and say, all right, Mr. Marcellus, this is how much equity you need to have going into your new HECM or to do a refinance HECM.
Gotcha. Gotcha. So I'm in here, man, and I'm listening to you, and I'm saying to myself, well, one of the things I'm trying to consider is how to get away from my mortgage payment. So I think I heard you say that's part of the thing, right? This can help you get away from the mortgage payment per se. Is that correct?
Sir, absolutely. You can be in a situation where you don't make a mortgage payment with a reverse mortgage slash HECM. So therefore, it's a financial tool. Sometimes people can make their payments, but they're saying, "Hey, I want to take that money and I want to pay down debt. I want to put that money away into a savings account. I want to put that money I want to do home repairs." So maybe for 6, 7 months, you just take your, traditional mortgage that you would have paid, okay, or you're onto your HECM. You decide I'm going to use that money if you've already used it, because there are ways you can keep it, and you just put that money away to make home repairs, or you draw down on it if you haven't used all of the equity, because you can walk out of a closing and have a line of credit, say, of $100,000, okay, and still not have a mortgage payment. You can draw down on that money and use it for anything else that we just talked about, whatever you want, you know. So yeah, you're 63 years old. Who knows? You might be water skiing, or you're thinking about a lake property, the whole 9 yards, right? So you can do all those great things and not have a mortgage payment. And again, I want people to think about, and I think it's great for you to put this out here on your platform, because what we want to do is make sure people know it's a financial tool. It is not a burden. Okay. We just have to manage it right.
Man, well, as a 63-year-old buff guy, man, you got me kind of excited. So what does the application process kind of look like?
It's like a forward mortgage. And here's the interesting thing. Now, some people, the question that we normally ask clients, or the conversation we get into with a forward mortgage is, what is your credit score, right? Or I need to pull your credit, do a soft pull to find out what your credit score is. I've had conversations with underwriters where the client doesn't have a credit score or doesn't have a good credit score at all. I mean, they're in the fives. So you can be in the fives, but there's going to be different stipulations. Sometimes with the HECM or reverse, you may have to, the underwriter may require us to pay your principal interest, your taxes and insurance on your behalf. Okay. We put some money aside for that to be paid if your credit score is not where it needs to be, if there's been some blemishes, etc. Okay. Other times, you as the homeowner are expected and to pay it yourself. On a traditional FHA transaction, under no circumstance will you ever pay your own taxes and insurance. You will always be paying your principal, your taxes and insurance with your forward mortgage payment. But in this one, there are situations where you can pay your own taxes and insurance. Now, is there any real benefit? Me personally, I say no, unless your insurance and your tax bill is $10,000 or more, and you're earning 4.5 to 5% interest in the bank. Outside of that, let us pay it because you're going to be paying it every year anyway. So there's no real benefit in my opinion.
So did I hear you correctly? It sounds like the loan amount may be determined by the equity I have in the property. Is that correct?
That is 110% correct. So the equity in your home is numero uno. That is the first question that I try to, ask the client by asking them, what is your estimated value right now? What is the balance on your first mortgage? And if you have a second mortgage, okay, we need to know that right away because that helps the conversation, go left or go right or go straight ahead. But it definitely gives me a lot of good information right from the very beginning.
But so it doesn't matter if I have a condo, single family, or townhome. I just need to have personal real estate property. Is that correct? In order to get maybe approved for this program.
Let me applaud you for that question. Thank you. That's a great question. Okay. It does make a difference. The difference is number one, it just has to be your primary residence. That's number one. Has to be your primary residence. After that, it's going to boil down to yes, equity, and then if it's a condo, is it on FHA or HUD's approved list? Okay. So townhomes, single family, yes. Co-ops, no. Can't do it with co-ops. So I'll tell you that. So
Gotcha.
yes, it definitely matters, and that's a beautiful question because yeah, it's got to be your primary residence. And if it's no longer your primary residence, then you need to call me and Marcellus, and let's come up with a strategy if you're thinking about moving. So you say, you know what? Hey, this has been great, great 5 to 10 year run. I'm ready to get out of this house. So now we need to put our heads together, let Marcellus run the numbers, put it in his real estate machine and find out what comps are in the area, look at the balance, and then we can make a decision on how you move forward strategically.
Gotcha. And now, so are there any upfront or ongoing fees associated with the reverse mortgage?
Nothing, no ongoing fees, just the interest that you are being charged, just like a forward mortgage. So, like I said too, or earlier, which definitely stands, it should be reiterated or repeated. So, when you have a reverse mortgage in the current market like this, interest rates are going to be one number. If rates go lower, okay, that's good, even in the reverse mortgage world, even though you're not making a payment, because that just means the the interest is not the principal is not growing that fast if you were in a quote unquote one interest rate environment versus another. Okay, so the higher the interest rates, the more equity you're going to be required to have in the property. And like I said earlier, the main driver is how old are you as it relates to you going into this HECM reverse mortgage slash reverse mortgage.
Gotcha. Now, sometimes brain fog is a thing for me, right? So I just gotta go back here real quick, right? So I heard you say something about property taxes and insurance. Now, I'm still responsible for that. Now, I think you said that I can have to still escrow it, or do I have to pay them myself?
So there's times where you're going to be required to set aside a certain amount of money for the taxes and insurance. So we'll do that up front. So let's say hypothetically, when it's all said and done, you've got 100,000 equity there. If your credit is not the best, then what we will do, the HECM underwriter will say, I need you to set aside X amount of dollars so we can pay the property taxes and insurance over this X number of years. Okay. That's how that would happen. Or you could say in your case, say, listen, look, I'm busy. I'm out here water skiing. I'm out here with my friends, my family, whatever you're doing, right? Oh, by the way, you're 63 year. Are you married or do you have a girlfriend? What's going
I
on? So
got
I
a
can
girlfriend, man. I ain't.
snap. Okay.
Make
So
that
you're out
three
there.
of them.
Oh, you get three. Oh, snap. All right. So you're out there with one of your girlfriends of the three. You know what I'm saying? You don't have time to be worried about taxes and insurance. You trying to figure out whose date night it is,
Oh,
right?
that's the game.
You try and figure out whose date night it is tonight, all right? And what's her name? So you're not gonna remember taxes and insurance issues. So yeah, you still can set aside and have that set up, even automatically on your own. Yeah.
But then the maintenance of the house is basically on me. There's no setup, no escrow or anything for that, right? I gotta figure that out.
Sure. You still figure that out. That's still your responsibility. It's still your home. And that's the main thing that a lot of people, they do get nervous about and say, hey, do I own this house or does the bank own the house? No, you still own the house. You still are responsible for the insurance. You still are responsible for the HVAC, for the, heating and it, whatever. Okay. It's your home. And if you expect to hand it over to your heirs, fine. Just strategically plan. Let's talk about it. I always say, let us as your real estate professionals know up front what you plan to do. What's your entry strategy and exit strategy? Okay. You say, okay, well, upon my demise, or in 5 years, 10 years, I want to get out of this house. We can play with numbers and say, okay, hey, Marcellus, what do you think it's going to be worth based on the current market, this house in this market? And then I'll say this is what the balance is going to be. And this is the balance if you make this payment or no payment. Okay. So that's how we can help build your wealth, as a transaction team and helping you understand here's how you enter, here's how you're going to exit, here's what's going to be left behind. If that's part of the transaction or conversation, yeah. So I think I answered your question, but yes, we can work through all those types of issues.
Man, but as you heard me say, I'm trying to keep my body good. I'm trying to keep my youth a little bit. So what happens if I stay around too long? Am I going to run out of equity?
Beautiful question. That's a possibility. Okay. However, what does that mean for you? It means absolutely nothing. So the HECM is set up so that when it's all said and done, as we move on, as you age and as the property moves down the line, if the value of the home is not outpacing the equity, I mean the principal growth, they are going to meet at some point. Okay. And let's say in the future, the balance of the mortgage is here and the value of the home is here. Nothing changes for you. Nothing changes for you. Nothing changes for you. Because that's where the actuarial scientists, that's how they earn their money. They're trying to manage and predict the scenario so that that doesn't happen. Okay. Because that's real money when the house has to go for sale. So if the house goes for sale, let's say hypothetically for $800,000 and you owe 850. All right. There's even you and I both know the 800,000 is about probably what we say 8-10% of expenses that go on top of the 800,000. Right. So now you're talking about 880 minus the 850. So again, in terms of expenses, rather, another $80,000 of expenses go on top of that mortgage of 850. So it can get ugly real quick, but it's
Yeah.
only going to get ugly real quick honestly, in this case, for HECM slash reverse slash HUD slash the bank who's dealing with the sale. Okay. Not the individual or their estate. So the estate is not going to be, burdened with the additional expenses above and beyond that, whatever that dollar amount is. So let's say in that case, we said we're upside down. Let's call it $60,000. That $60,000 does not go against the estate.
Gotcha. Now I think I heard you say this, but the reverse mortgage, I retain ownership. It doesn't go to the lender just because. I'm now in this reverse mortgage, right? So I do retain ownership of the property.
And let's say hypothetically, Marcellus, you decide to settle down and marry one of your girlfriends, right?
Hmm.
You're now the ripe old age of 80, which is still young in this world because people are active. To your point, if you know she comes on deed, etc. Spouses do play a role in how much equity you have. So if you're entering a HECM and or doing a refinance on a HECM, okay, your spouse's age will be taken into consideration. So they'll do the equity based on the age of the younger of the two, okay, of the spouse. But upon your demise, even though your spouse is not on the loan, they still can take advantage of the benefits of the HECM.
Okay. Wow. Wow. So is there any time that during the period that the reverse mortgage need to be repaid? And if so, who would be responsible for the repayment if the it's just like a regular mortgage, right? It's just until something happens to you, etc. Right?
Correct. Yeah. So again, going back to our scenario, houses were selling for 800. Now the balance is 790 on the HECM or the reverse mortgage. At that point, you just expect very little. I think now they're working it out in some cases where you can get a little teeny bit. The heirs can get some money, but it's super low. It's like pennies. It's not anything close to what they would want. That's why I say it's really important. Because see, the other thing too, before you go into this HECM, you're going to go through a course designed by HUD, just like a first-time home buyer course. You're going to go through that to help you understand. I always like to ask clients who are thinking about a reverse, who else in your family is going to be concerned and should be part of this conversation, because that way everyone is aware. Because not knowing can be a disaster.
Gotcha, gotcha. Now, there's a real estate agent that may be watching this, May Campbell. She actually is dealing with a situation right now. I want to see if you might can help a little bit to help us understand. So she has a family member who their mom passed, and it's a reverse mortgage. Now, they're looking at trying to sell it and maybe to another family member. Do you have any information on uh, what that should kind of look like? Because right now, I think the son reached out to the lender, and the lender provided like a short sale package or something like that. So at this point, the only thing they probably need to do is the son probably, if there's not equity there, right? The son probably needs to go ahead and fill out the short sale package and pretty much go and follow through with the listing and whatever the bank says at that point, correct?
You got it. That's it. I mean, I think the best thing for real estate agents to do as it relates to, thinking about a reverse mortgage, forget the fact that it's a reverse mortgage. Know that everything else is pretty much the same. Do you want to stay in touch with, and you want to be in touch with someone who's, the executive of the estate. They themselves should, make a contact and say, hey, this person, is passed. We're in the process of selling the home. Anything I need to know, et cetera. Just like, anything else. Or, get the title company involved. Okay. And then after that, everything else is just like a traditional transaction. Either they're going to get money or they're not, based on the value of the house and based on the balance of the mortgage.
Gotcha, gotcha. And
Yeah.
there's always some misconceptions and myths in regards to any program. What are some of the ones that you've heard or um, that you know of that people have for this program?
Really is that the house, belongs to the bank now. And if there's any equity left over, the family, the heirs do not get any of that money. That is not true at all. Okay. Equity is still equity, even with a reverse mortgage on the property. If there's no equity, there's no equity, and there's no equity give to the heirs or to the estate. That's the main message. Don't let other people's bad experiences or hearing portions of their story about their bad experience deter you from looking into this to see if it's a good idea for you to take this product yourself personally and or take this product and present it to your client as an option because the reality is this. Hey, Doge is happening, right? People who are senior within the federal government, they may be in a situation where they no longer have that same salary. So they are looking for ways to perhaps stay in place. We call it aging in place, right?
Hmm.
Using a reverse mortgage slash HECM is one way to do it. So aging in place, in other words, I can't make that payment I used to make because I don't have the income I used to have, right? So how do I do it? I sometimes the answer is reverse mortgage. Sometimes the answer is sell and you want to stay in the area and it's still reverse mortgage. So the answer is going to be one of two. And it's a real thing. It's very stressful. I've had, unfortunately, some conversations with people. And I think as real estate professionals, we have to make sure that the clients are, aware of everything, regardless of what others have heard. The way I would present this, if I'm you in your real estate agent shoes, I would say, hey, listen, this is another financial tool that we should consider if we want to age in place or stay in this area, and we realize that your income has dropped anywhere from, probably 30 to 40%. And that's a huge drop.
And to your point, and you can correct me if I'm wrong with this, it could possibly, and you said it, I think you said a little bit of this earlier, it could also be a good opportunity. Let's say, for instance, that the homeowner wants to do the reverse mortgage and not concerned about leaving the property to the heirs, right? But because they don't have the mortgage payment, they now take this mortgage payment and set up some other type of financial situation that will help the family once they deceased.
Yeah, absolutely. I'll give you a similar example. And this can work in a reverse mortgage scenario. So this client of mine, she sold a property. I'm sorry, she moved out of a property and was buying a new one, and she was going to rent out her old property. Okay. And you can think about this almost as a reverse. So anyway, she's renting out the old property and she had this money coming in. She says, what I'm going to do with that money, I'm going to take it and I'm going to put it against my new mortgage and I'll pay it off faster. I said, that's one idea. So with my software that I have, I took it and because it's called something called mortgage coach rather. And I put it in my software. She was going to have $3,000. I think it was around $3,000 a month. Okay. After she paid taxes and insurance on the old house, she was going to have that $3,000 and put it away for 15 years, earning 8% rate of return. So the 8% comes from just understanding and knowing what we call a balanced portfolio looks like. In mutual funds, could be EFTs, doesn't matter, right? But just an investment. So 60% stocks, 40% bonds, which means it's you got the steadiness of the bonds, but you buying blue chip stocks at the same time. Now, I'm not an investment advisor. I don't have my license for that anymore. I'm just again setting the stage. So within 15 years, she was going to have $1 million. And during that presentation, she started crying. I said, "Why are you crying?" She says, because I've been trying to figure out how am I going to increase or, I'm sorry, fund our family's educational trust we were trying to set up. And you just showed me how to do that. So to your point, Marcellus, yeah, you could take that money that you would normally pay toward a mortgage. You could put that into another investment vehicle for your family's long term, because generally speaking, if you look at a national average, okay, according to Ibbotson, which is one of these asset tracking firms, they look at all major classes of assets. Real estate on average is growing at a rate of 4% per year. That's good. That's not bad at all. Around here, we may see a 6 or 7, and then the next year we may see a 2 or 3. All right. But when it's all said and done, when we look over time, it's about 4% or higher. Okay. Especially, in the DC market and et cetera, in certain streets in
Hmm.
Baltimore, right? In
Hmm.
certain neighborhoods. So, so that's good, right? 4 to 6% return. That's good. But if you could take that money and put it into something else, okay, and that's growing at a rate of 8 to 10% for your family probably like that too.
hmm
Maybe there's no equity in the house upon your demise, right?
hmm
Because let's assume you're not making any mortgage payments. You're just taking that money and you're just investing it and you're just letting it grow, okay? Properly, nothing risky. It's just good, solid investments. And over time, you probably can see an 8% return. Could probably, past performance is not indicative of future results. Same thing with real estate, stocks, bonds, mutual funds, art, whatever, precious metals, whatever. There's no guarantee what's going to happen in the future. All right. Especially, we've all learned that with COVID,
Right.
right? So the point is, yeah, absolutely. That's a great question. Great point. There are other asset classes you can look at besides just putting your money in real estate. And that reverse mortgage allows you to have that liquidity. Because just think, if you say a person's got extra $2,000, that's 24,000 a year. You put that away, and now all of a sudden you put away $48,000 in 2 years, and in 3 years, I mean, it just compounds. That's just the cash part.
Yeah.
Let alone now you're talking about what does that 7% look like? I mean, what does 8% look like? What does 5% look like? What does that look like with just, municipal bonds, this tax free at certain levels. So, talk to your tax advisor. There's just so many more options, we need to consider because guess what? Everyone else is.
Yeah. Yeah.
you know, your neighbors are considered. They might not be coming out and talking about it. But when we give our clients these ideas, now we're the expert because we got to know a little bit more because the internet is great, right? But it also makes some people think they're a total expert just because they've got 2 or 3 sentences. But yeah, I think it's a great product for building wealth different ways.
Gotcha. 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 So, man, where can the viewers find relatable information and resources that you have on this topic?
Contact me directly. I always like to do that because no two applications are alike. No two scenarios are alike. You know, you know how it is in our business. The same client is not the same client when they come back.
Yeah.
You know, now they got equity. The first time you met them, they might have had, okay credit and they had no money, but down payment and closing costs. Now they're ready to sell a house. That's a whole new client.
hmm
Credit's great. They got equity. You know what I'm saying? Now we're in that neighborhood.
Right.
you
Right.
know, we over there.
Right.
We started from the bottom, now we're here.
Right.
Right?
Right.
So I always like to say too, is clients are like fingerprints. Nobody has the same fingerprints, and there's no two clients that are alike. So general information, why go off the rack? I see, sharp as you are, right? Off the rack. You know what that means. You
hmm
just pulling off the rack. You
Right.
just
Right.
pulling. Why not get why not get measured? Why not get a tailored suit? Why not get a tailored shirt? Ladies dress. You know, let's talk specifically for your situation or situation.
Right. Right.
Right?
Right.
However
Right.
you want to do it.
And also,
So
it's go ahead.
yeah, so my number 202-409-8103, 202-409-8103. Okay, that's my cell. And then you can go to loandepot.com/Brian Washington, Brian Washington. I'm hoping you're going to be able to put some of this information out there. And then my email is brianwashington@loandepot.com, Brian Washington at LOANDEPOT.com. Okay, just reach out to me and say, hey, I got a scenario, or hey, send me some material back. I may ask you a couple questions and I'll send you some nice, marketing pieces. Real simple. Actually, there's one piece I have where it's got Q&As on there as well. Maybe something we didn't cover here today could be answered even in that marketing piece that you'll really enjoy and like.
And Brian is easy to find on Google. You're able to Google him. He pops right up, goes right to you can have access to go right to the Loan Depot website. And I went on there and did some searches and resources and stuff. So you can actually go on there and find different information on different loans in there. if you want to do some reading on your own, and then you give Brian a call to help you out with some of the information you don't understand. Also, if you're following on YouTube, in the description, Brian's information is in there, so his phone number and all of that stuff. So you won't have to, you don't have your pen to write down the information he just gave you. It is going to be there, and it should be on some of the other platforms as well. So, hey, Brian, we thank you. You have anything else that you want to share before we go?
I just applaud you, my friend. This is awesome. I think it's a great topic. People want to know about this, and so I'm glad that you're doing this. And yeah, by all means, again, let me know that if you reach out, just hey, let me know that you found me here with Marcellus, so that way we can reference this, and who knows, figure out something special for you.
Hey,
Yeah, thank you first of all, sir. I really do appreciate the opportunity to come here and talk about this. It's a great product.
hey, I thank you again. And for folks out there, this is the start of a new Hump Day Real Estate with Kendell in the DMV. I will be back every Wednesday at 7 p.m. to get you more news that you can use, real estate news that you can use. And we're signing out. Thanks you again, Brian. I'll connect with you soon.
Sir, have a good one.
Have a
Thanks
blessed one.
again.
Yep.
You too. Be blessed.